Hello and welcome everyone to This Is It, final week 8 of personal finance. We do have a very short week this week. Everything has to be done by Thursday, so please do not hesitate or procrastinate. We have our week 8 discussion. We have chapter 16 problems. We have the continuing case study for both chapter 16 and 17, the quiz for chapter 16 and 17, test number 4, and the final exam, all due by Thursday. So this is not the week to procrastinate on getting things done. So I do want to kind of, as always, go through everything with you. I have to go along with information that I'm going to cover in the chapter. I've added some stuff to the supplementary resources that you may find helpful or interesting in in the current day. By the time you're ready to retire, of course, everything will be changed because it'll all change by next year. They change it seems like every year. But I have downloaded the Social Security Administration Benefits Packet 2026. It's a PDF from the Social Security Administration, and the Medicare and You Handbook for 2026, which Medicare is the insurance, the medical insurance that goes hand in hand with Social Security. So if you are receiving Social Security benefits, Medicare will kick in on your health benefits side. There's also some retirement planning tools, financial planning tools, a lot of good things that you might want to check out the supplementary exercises this go around, even if you haven't ever done so in the past. But if you've kind of gotten the habit of looking at them, you'll find some very interesting things there that are helpful for this week. So let's take a quick look at chapters 16 and chapter 17. I've got them both up here and ready to go. Chapter 16 is retirement and estate planning. And, this is an important part of our lives as we go through the different life stages. We have 3 major learning objectives for this chapter. We want to recognize the benefits of retirement planning and how important it is to start this process early. You cannot wait until it's time to retire to plan for retirement. As we've learned with so many other concepts in this class, you've got to do things in advance. You can't plan to save someday and never ever put any money away, and then all of a sudden you need savings and you have no money put away. It's the same kind of concept. Learning objective 2, we're going to talk about the importance of having a will and other advanced directive documents, and how estate planning methods can be used to transfer wealth. Nobody likes to talk about this, but it's a part of life. Everybody passes, and you need to have a plan for what happens to your accumulated assets when you pass from this world. And then learning objective number 3 is, let's talk about charitable giving while you're still alive. We talk about giving to charities, giving other things. There's a certain amount of money you can give away per year that actually can help your tax liability. So we need to talk about that a little bit as well. So some reasons to save for retirement. Many people think about reasons, about retirement and everything. Right now, as a new or soon to be graduate, you may be just starting your college career and just graduated from high school, or you may be approaching a graduation from college and you're ready to start your career. Retirement is so far away for you that it's not even on the horizon yet. Especially if you're a traditional student. Especially if you're a traditional student. We're talking about something that might be happening 50 years down the road for you. So, you think like, I can just kick that can down the road. I don't need to think about it right now. But you really do, because the thing is, the earlier you start, you can start with a smaller amount and put a smaller amount away for a longer period of time and still grow your money. You don't have to put away, a whole lot of your paycheck towards savings or retirement, but a little bit going ahead and starting will actually pay off very well when you get older. A lack of choice is, the chart that I'm looking at with the PowerPoints is change of heart. You're thinking now it'll never come, but suddenly you'll be my age and it's here. So better to save now and have the option to retire than to be, according to the slide, 65 years old, burned out, and have no savings. Boy, that's the truth. I'm not 65 years old. I'm not burned out. I do have some savings. But I have a pretty good retirement plan because I've always put away for retirement. No matter what job I've had, as long as they offered a retirement plan, I participated in it. So, some times when you get a certain age, and heaven forbid, I'm going to knock on my desk, knock on wood, the choice to retire is taken away from you. You get sick. Something goes wrong, heaven forbid, and you are forced to retire. Your company may downsize or merge with another company, and your position is eliminated, and you're at an age where you go, God, do I want to start over? And if you have no retirement to fall back on, you have no choice. You have to start over. And so saving for retirement gives you flexibility when you reach an older age. If you have a family, which everybody has some kind of family, I guess. But anyway, sometimes your family is blood, sometimes your family is chosen. But retirement savings can be passed along to any children that you may have or any others that, like I do not have any biological children, but I have friends of my family that I have watched them grow up since they were children. They consider me a family member. I consider them like a niece or nephew. So that's my plan. So it's a chosen family, not a biological family. When sabbatical options, retirement allows you to take time off of work to go pursue something that you want to do. A sabbatical is when you go and pursue an interest, like as a person who likes history. Perhaps I want to go explore Italy and look at ancient Rome and the Colosseum and all that kind of stuff. I could do that on a sabbatical. And a second lifetime career option. You may at some point in time want to switch careers. Most people do. In fact, especially in generations after mine, it becomes quite normal for people to switch careers. And so having savings and retirement that you could possibly borrow against allows you to have the freedom to go, I want to take a break. I want to go back to school. I want to retrench and start a new career, and I'm not going to make as much money to start with, but I have this savings to tide me over until I get back to where I am now. So it's like a landing place, a parachute, if you will. So there's many reasons to save money. We're going to talk about some company retirement plans if you work for someone else. We have what's called traditional and Roth 401ks. A traditional 401k plan, your money is deducted pre-tax from your paycheck, and it continues to grow tax deferred. Some companies may match a percentage, which is technically free money. This is different from a traditional pension plan. A pension plan used to be something that was very common. You didn't pay into it. The company just paid into the retirement for you, and you got a retirement check when you retired, and you never had paid anything in. Well, now it's more of these matching retirement plans where you pay part, the company pays part, and you get your retirement pay when it's time to retire. Most of them do require what's called a vesting period. A vesting period is a time that you work for the company, and even though you're paying into the retirement plan, if you don't work a certain amount of time, you don't get retirement. It's like a trial period, I guess. It could be 1 year. Some of them are up to 5 years, but it's kind of tried to encourage longevity and retention for the company. I'm paying into the retirement plan, at least let me get vested so I can get a retirement check. I just heard a weird noise out there in the hallway. I hope nobody fell. Anyway, there's a lot of investment options that revolve around a 401k plan. Sometimes you have the opportunity to guide how your investments are done. Other times it's done for you through a mutual fund through your company. There's no penalty for access after age 59 and a half. So once you reach 59 and a half, you can take the money and just withdraw it with no penalty. Prior to 59 and a half, there's usually some sort of a small early withdrawal penalty against it. Other plans I know can let you borrow money out of your plan with the idea that you pay it back with interest, just like a loan from the bank. But when traditional 401k, when you start withdrawing your money, that's when you pay the taxes on it. So it helps you as you are working because it reduces your tax liability as you're paying in, and then you pay the taxes on the money that you draw out when it's time to draw it out. A Roth 401k is the same kind of options, except for one major difference. The money is deducted after taxes are taken from your paycheck. So technically you're paying taxes on the money before it's withdrawn from your paycheck. So you pay them as you go along through your life. And again, matching the same, the rest of it's the same. There's a matching, it grows tax-free for you technically because you're paying the taxes on your income before it's taken out. The company may have a match that they do for you, just like with a regular 401k. There's usually a vesting period. The investment options are the same. It depends on your plan. No penalty access after age 59 and a half, just like the other one. But the big difference is you've already paid the taxes before the money was taken out of your paycheck. So therefore, when you start to withdraw, you don't owe any more taxes. You just get your money tax-free. So it's kind of there's an old commercial. It was for Meineke mufflers, and the guy was taking his car in, or the girl was taking her car in to the repair shop, and the Meineke guy says, well, you need this and this done on your car, and they go, well, I'm going to wait and do that later. And the Meineke guy goes, well, you can pay me now or you can pay me later. Basically, the government's going to get their tax money from you. You can either pay it as you go, as you earn, or you can pay it when you withdraw. There are advantages to both. If you are not making a lot of money as you're growing through your career, it's better to wait until or some people would say it's better to wait until you're comfortable and you've kind of built up the money to where you're getting a pretty good retirement check that you can afford to kind of absorb those taxes then. The other thought process is I'll bite the bullet now and pay it now, and that way when it is time to retire, I can relax and just enjoy my money. Both ideas are perfectly fine. It just depends on what you feel like you can afford, in your lifestyle. In other words, it comes down to, can I pay my bills? And so some people say I need the tax money I need it to be taken out pre-tax, so I take home more money so I can pay my bills. Other people say I'm going to hurt now in terms of going ahead and paying the taxes on it so I can enjoy it later. It's a personal decision. We talked about pensions. A simplified employee pension or an SEP is good for small companies or self-employed individuals. Again, it's usually a situation where the company pays for the entire amount, but it does allow for pre-tax contributions if you want to set it up as a contribution system. It's very similar to a traditional 401k. And then there's a little screen in the PowerPoint that just compares traditional IRAs and Roth IRAs. IRA is Individual Retirement Account. That's what the acronym stands for. And that's for people who work for themselves. If you are self-employed, you don't get a W-2. You get a 1099. You don't get all you have to pay everything yourself. There's not an employer to pay in for you. So you can set up an individual retirement account. and you can do so in the traditional method, just like 401k, where the contributions are done pre-tax, or it can be set up as a Roth IRA, like a Roth 401k, where the contributions come out after you've paid your income taxes. But basically, it's the exact same thing. It's just it's set up for people who work for themselves, because there's no employer to do the 401k for them. You're paying the whole amount. And so as we go through the PowerPoint, through the chapter and through the PowerPoint slides, there is a little chart that shows the difference in tax-free versus taxable amounts. And of course, this is an estimate. But you can see that the red line is tax-free and the green line is taxable, which you're putting in more money with the tax-free, but then at the end of the game, you're having to pay back the taxes. So again, I honestly, while this chart is valuable, just remember that it kind of all evens out in the end. You're either going to pay them, you're going to pay the taxes as you go, or you're going to pay them when you withdraw as you go. Some other retirement options. You can have a spousal IRA, where if you're working for yourself, or actually even if not, if you have a spouse that is either not working or maybe running a small business for themselves or something like that, you're working and your spouse is not working, or you're the spouse that's not working or is unequally compensated for their work, a spouse can set up for another spouse a spousal IRA. These people must file a joint tax return. You can't do married filing separately, and obviously you can't do single or divorced or head of household. So you have to file a joint tax return. It's married couples where one member of the couple is very unevenly compensated to the other. And so the more compensated individual sets up an IRA on the benefit of the less compensated individual, with the idea, remember what I said earlier about we all come to the end of our life, with the idea that as retirement approaches, if one of you, if this person who's making more money passes away, this person will receive whatever Social Security benefits plus the benefit of the spousal IRA that was set up to their benefit. So that's one way of setting it up. And then annuities are, it's a product that you buy usually through an insurance company, and it provides a steady stream of income in retirement. And it's kind of like you put a big bubble payment in, and then you get to withdraw a stream of income from it. If you're familiar with the commercial about J.G. Wentworth, 877 Cash Now, not sponsored, but you they purchase annuities for people who have, let's say you've bought into an annuity and you're like, oh, this is taking forever, I just want to get my money back. Well, the J.G. Wentworth company will purchase the annuity from you for the current value of whatever you've put in there, and then they will hold it for the future value, as we've talked about future value money back in the beginning in chapter 2, I believe, or chapter 3. Anyway, they'll hold it to till it matures, so they can get the extra money for you. They'll pay you out for what you want out of it, or what you can get out of it in terms of current value, and then they take the rest. There is a retirement fund comparison, which is very, very small. If you want to make it larger on your screen, of course you can enlarge it, but it compares 401ks and Roth 401ks and IRAs and Roth IRAs for different under different categories. It was extracted from the IRS.gov retirement plans page. I went there just before starting to record this video and tried to find an updated version of this, and I could not do so. There is, if you go to irs.gov/retirement-plans, like is indicated on the screen there, you can go to forms and documentation, and there forms and publications, excuse me, and there is a whole list of, you go past the forms, and there is a whole section of publications on different topics, but I could not find one that matched this completely, so I just want to invite you to go there if you're interested and look over the publications that are available for retirement options. So let's talk about Social Security. Most people are at least vaguely familiar with Social Security. It began in August of 1935. It is not really a retirement fund, or was not really supposed to be a retirement fund. It was supposed to be a little safety net for people who had other money, just to make sure they had some money coming in to help, like, stopgap and pay anything that their retirement didn't cover. It has kind of grown into something where people had the expectation that is their retirement plan, but they should not have that expectation. It was never meant to do that. So if you're of the opinion that you're just going to wait and draw your Social Security and that will be your retirement, let me tell you now that that is not a good plan. Okay, please, please, please do not do that, because it's not going to be enough to live off of. So, just understand that. The benefits are based on your average lifetime earnings of your 35 highest years of wages. You have to you have to have money over a certain amount of time. They call them quarters, like quarter years. They track how many quarter years you've been employed, and they add that up to your 35 highest years of wages, and that is what happens based on when you retire. And if you look, the longer you wait to draw your Social Security, the higher the monthly amount. Now, are you a gambler? Again, is the question. If you take your Social Security at age 62, you're only going to get 75% of what you would get if you waited to age 66 right now. Now, of course, remember, these things sometimes jump up, okay? In fact, let me do a quick check, because I think it's changed already. Retirement ages for Social Security. I meant to do this before I started recording, because I was looking at some other stuff. Oh, I did not want that. Let's see. How about doing this? SSA, www.ssa.gov. Benefits. You can do starting at age 62. So that technically, I guess it's still accurate. The information that's in Chapter 16 is still accurate. So if you start taking your retirement, Social Security retirement at age 62, you will draw 75% of what you would make if you waited to age 66 to start taking your retirement benefits. If you wait to age 66, you're going to get 100% of what you're owed based on what you've made over your 35 years of wages. And then at age 70, if you wait longer and push it back, they'll give you 132% of what you would have, of what you make if you started at age 66. So are you a gambler? I think you need to look at what your health looks like when you approach this age. If you are age 62 and you have health problems that you feel like, you know what, I may not make it as long as I expected, go ahead and take your Social Security retirement. Because what you don't want to do, is wait to age 66, have paid into this stuff all your life, get retirement payments for who knows, like, how long, maybe a year or 2 years. Unfortunately, you pass away, and the rest of all that money that you've paid in all those years just stays in the pool, and somebody else draws it out. You can't inherit Social Security. So this money goes into the Social Security pool to be used by everyone, and depending upon who gets it and where, you may get everything that you paid back, you may not. So if you're nice and healthy at age 62 and you're still working and you're fine, in other words, I feel like I'm fairly healthy, I will be 62 in August. So I do not plan to start taking my Social Security at age 62. I plan on waiting. But if my health rapidly declines or something like that, heaven forbid, I'll be looking at going ahead and starting withdrawing my Social Security, because you can't will it to anybody. If you don't use it, you will lose it. So just be aware of what your situation is when you get to that age. And I hope that you all are in the position where you can say, oh, no, I'm going to wait. So you'll still be healthy and happy and going about your life. All right. So here is a sample of your monthly benefit amounts. This example assumes a benefit of $1,000 at full retirement at age 66. So this is easy math. So like I said, if you were expecting a benefit of $1,000 at age 66, you get $750 a month at 62, $800 at 63, $866 at 64, $933 at 65. The $1,000 that you are owed at 66, and it goes up to $1,080, $1,160, $1,240, and $1,320 from there. Now, that's assuming that your benefit per month is $1,000, just so they could do the easy math. Understand this is a scale that goes up and down based on what you earn. Next is a sample of a Social Security statement, and they still kind of look like that. I get mine through my email instead of in the mail, and it's sent periodically to you once you are vested, and since you've got your quarters in where you're going to get a Social Security check, they can start sending you a statement I think it's every year that you get a statement of, what's going on with your Social Security account, and it shows you, as you can see here, what is your estimated benefits, what's your monthly Social Security payment going to be, depending upon, I made it go away, depending upon when you take it. Okay, so this one says at age 63, 66, and age 70. So, anyway, so, I guess it just watch for it, because I feel like that as we continue to live longer, the age will jump up a little bit. So, when we talk about life stages, as we've done, here and there, late dependent, independent, Roth IRA, you have, if you give one small investment at age 16 and you just do, you pay in $1,000 at age 16, okay? And you don't do anything, you just kind of let it go, and you don't worry about it, you kind of forget about it. At age 66, now of course this is dependent upon the market, this is dependent upon the stock market, because it's an investment fund. Your $1,000 could have grow to, they estimate an average of $117,391, and at age 70, $171,872. At age 16, if you do an initial investment of $5,000 and you let it just age to 66, $586,954, and age 70, $859,360. Remember, I said at the beginning, a lot of people at a young age don't think about going ahead and putting money away. But if you go ahead, if you put money away for retirement and just forget about it and let it grow, it's surprising how much it will grow. I had a job many years ago that started a 401k plan about maybe 3 months before I quit that job and went somewhere else. And I think I put $850 total investment into it through my pay. And I moved, I started a new job, taking care of older parents, which is something that a lot of us will do. Life just kind of lifed along, and I forgot about moving it. I never thought about moving it, and you do get statements on these things, and I just, kind of look and just don't think about it. And one day I actually looked, and this has been a while, probably probably before I started working here. So it's probably been 15 years since I really paid attention to it, because remember, it goes up and down. If you start paying super attention to it, you probably freak yourself out because it's in the stock market. But I remember it was $850. So, and I was probably 27, 28 at that time, a little bit older. Yeah. And when I looked at the statement, it had grown to like $10,000 at that time. And I was like, whoa. And so that was, many years ago. And so I'll have to look at that statement next time it comes. Anyway, I just left it there just to see, kind of like an experiment, to see what would happen to that small amount of money that I invested when I was 27, I think, and just to see what it comes to when it's time for me to retire, because it's just one part of my retirement plan, and it was just a small investment just to see, just a little experiment, but it does grow. So I don't know what your financial situation is. It's none of my business. But any money that you can save to go ahead and start putting away in a retirement plan, you can see here from this screen that it does grow exponentially over time. So some life stages, early family, so late dependent, independent. So this is when you're still kind of young, so age 16. A lot of people have a job by the time they're 16, or they're becoming independent, 16, 17, 18, they're moving on their own, or they're remaining dependent a little while longer while they go to college. Early family is, most people traditionally are in their 20s. They have gotten married. Go ahead and start, if you can, start the Roth IRA or a 401k of some sort. By age 44, to try to have 2 times your annual salary in a retirement account. So if you're making, the goal by age 44, if you could do it, is to, let's say, I like easy math too. Let's say if you're making $100,000 a year, you need to have $200,000 in your retirement account by age 44. Empty nest is after you've had your children and they grow up and they go away and it's just you and your spouse back in the home again. You want to maximize your contributions, because you should be making good money by then. Your house hopefully is close to being paid for. Maybe you've bought a car or something. In other words, you've made all the big purchases, hopefully, and you can really maximize some more stuff, putting money in your accounts. Goal by age 54, 10 years later, to have 4 times your annual salary. So if again, just going with easy math, $200,000 at age 44, double it again to $400,000 by the time you reach age 54. And don't take that as a recommendation. That's easy math. I don't know that I think you would need more than that to comfortably live off of, especially at your age going forward in terms of time. Once you hit retirement, if you're still working, go ahead and start and keep contributing. Go ahead and start planning when to retire and start your Social Security. You may start a second career. You may work part-time. I will say that with some professions, I am familiar with the state employees retirement system. As a teacher, you can teach and then retire and stay retired for, you have to stay retired for, I believe, 6 months. Maybe it's a year now. And then you can go back in and teach part-time while you draw your retirement from the state plan with no penalty, but you do have to take that break. And there is a certain amount of money that you can make per year as a retiree and it not affect your Social Security. If you hit that level, your Social Security will decrease to compensate for the money you're making. Because what I say, Social Security is a stopgap. It's not a retirement plan. And so how do they know? Your income statements. your W-2s, all those kind of things. So you need to be careful of that. And why I'm not giving you specific numbers is it changes every year. So by the time you need this information, it'll be way out of date. So just make sure that you stay up with the current requirements. Estate planning is the end of life planning. The last will and testament, or the will, is very important. It's a document that a lot of people don't like to talk about because people don't like to talk about dying. But living and dying go hand in hand. It's just the way it goes. The term testate means you have a will when you die. If you die without a will, you die intestate, and that causes a lot of problems for the people who come behind you to try to figure out what to do with your assets. The will is a legal document that specifies how you want your assets distributed. The executor or executrix, if that person is female, is the person that you name who you want to handle your will and distribution of your assets afterwards. If they can get paid. In fact, it's usually in the provision in the will of how much they get paid. They don't have to be paid, especially if they're a major benefactor. You probably don't pay them, and I mean, you can. It's up to you, because it is your last will and testament. It's your last thing on earth that's going to be done according to your wishes. It includes a letter of intent, which is the instructions to your heirs and to your executor, and it tells them what to do. If you die without a will, you die in a state called intestate, without a will. That's the legal term for without a will. The court determines, in the slide it says the court determines who gets what. In North Carolina, an administrator or an administrix, if female, is appointed by the court for the deposition of your assets. I know this from personal experience because I went through it with my father when he passed away. My mother and father, and I don't know how common this is now, my mother and father were married for 55 years before my mother passed away, and they had what was called a joint will. And basically it was very simple. A joint will is for both of them, and it said whoever dies first, the other one gets everything, unless they die together or within 30 days of each other. Like let's say there was an accident and then one died immediately and the other one was hurt and then died later. Anyway, if they died together or within 30 days of each other, their heir, me, I would get everything. So, long story long, my mother passed away. I went with my father to the courthouse to probate her will, which is what you do when a last will and testament goes into effect. You go down to court, you go to probate court. It was bam, bam, bam. 5 minutes, they read the will, they saw what was going on. You see a lot on TV where it's this dramatic reading of the will by a lawyer. I'm sure that happens as well, but in North Carolina, it's a very simple process. We just went down there, probated the will. They looked at the will, they said everything looks good. Because it was so simple, everything went to my dad. There was really no big dramatic reveal. And then after the 30 days was over, actually way longer after that, I wanted to wait until I felt comfortable discussing it with my dad. But I told him, I said, you need to rewrite a will because the old will has been probated and the 30 days that were specified have elapsed and now you don't have a will. Oh, you don't know what you're talking about, he said. I said, okay. And I don't know if you've ever had to deal with an older parent. Pardon me. But if you haven't had to yet, someday you will. And as adults, we can be quite hard-headed. And so no matter how I brought it up to him, without trying to hurt his feelings, the gentleman was convinced that he was right and I was wrong, and that the will that had been probated once would be probated again. That's incorrect. Once a will is probated, it's over. So when my father died, I went down to the courthouse. We had to have a judge. We had to have a court hearing. I had to put a notice in the newspaper of the death of my father and wait a certain number of days to see if anybody else was going to come forward and claim part of his assets, which was my inheritance. I had to it was a whole year. I had to be named the administratrix of the estate. I had to do an accounting of everything that my father owned. money, assets, retirement holdings, house, cars, everything. I had to turn it in to the courts. They had to go over everything to make sure I wasn't, lying about stuff. And then we had to wait to see if we had to get a survey of his land. It was very intense. And at the end of all the time, after a year, it was determined that I was, in fact, his heir, and I got ownership of his assets. So that's up to you. But probate is basically, in North Carolina, it was very easy. And just went down there, they read the will, they looked, they said, show me your ID, is this you? Okay, you're good, let's go. Without a will, it becomes a process. So please plan ahead. Estate and inheritance taxes. In 2016, a 5.45 million exemption up to 40% in excess of 5.45 million. Estate tax, that's how much was collected, and if you look at the states, they have estate taxes in the states in red. North Carolina has them. Inheritance taxes in the state in yellow or kind of gold, and both in the states in blue, which is New Jersey and Maryland. In North Carolina, on the little chart there, where are we located? Why are we not on there? We're in red. Anyway, it was $1 million. I believe it is still $1 million. So if you, in North Carolina, if your estate is less than $1 million, you are exempt from paying estate taxes. Not everybody has to pay them, even though there is an estate tax in effect. So it's the tax on your estate at the time of your death. So what happens if you don't pay it? There is a lot of things that can happen if you don't pay it in a timely fashion. I made the little screen bigger so I could see. I thought we were on there. Let's look really quick. North Carolina. North Carolina estate taxes 2026, because that slide is now 10 years old. Okay, good news. North Carolina does not impose state, estate, or inheritance taxes as of 2026. So that slide has old information on it, which we knew because it was from 2016. Meaning residents can pass assets to their heirs without state-level death taxes. Huzzah! While state taxes are absent, estates may still be subject to federal estate tax with a high exemption threshold of $15 million per individual for 2026. So, the state, North Carolina, repealed its estate taxes way back in 2013. So that slide was wrong from the get-go. No estate or inheritance tax exists. In 2026, federal exemption increases to $15 million per person or $30 million for a married couple. So, again, if someone dies and their estate is less than $15 million, then their family doesn't have to pay federal estate taxes. If a married couple were to happen to die together, again in some kind of an accident, that exemption is $30 million. The lifetime gift and estate tax exemption is $15 million in 2026, and annual gift exclusions rise to $19,000 per recipient, according to insights from Harvell and Collins. And no state inheritance tax applies to beneficiaries in North Carolina. But you still have to go through the probate process. Now, we'll come back to that that gift tax. Remember, it's $19,000 per recipient, according to up to 15 million. Okay, so let's see. Let's go back to the presentation. So trusts. A trust is a money that is set up for someone to get the money. When you inherit something, generally you inherit it all at one time. A trust is when you want someone to have a stream of income. So for example, let's say you get married and you have a child late in life and you're afraid that maybe you won't be there for their entire life until they grow up. You could set up a trust to benefit them to where they would get a certain amount of money per month. You could set up a trust for them to go to college so that their college would be paid for. You can set up trusts for various reasons. The trustor is the person who puts the money into the trust. So you would set up the trust for somebody else. The trustee is the person who manages the trust, usually a lawyer or an accountant, or an insurance agent. The beneficiary is the person who receives the money. A revocable trust is something that can be changed at any time. So, if you might say, you know what, I'm not sure I want this, maybe I can change it later, I want to change it later, you can set it up to be changed. An irrevocable trust cannot be changed. Pretty simple and straightforward. A bypass trust is used to reduce inheritance and estate taxes because you're giving it over time, which in North Carolina, if you're living in North Carolina, we don't have to worry about that unless you have $15 million at the federal level. A charitable remainder trust, you're not giving money to an individual, you're giving money to a charity or an organization, and you can take the tax deduction when you give to the trust and give the money, and you can also, if there's any profits from the trust, from the investments, you can get the benefits of the profits of the trust until you die, and then those profits go to the charity organization. And they have a revocable living trust, which is used to avoid probate. So a little note about inheritance tax. John Dorrance, who was an heir to Campbell Soup Corporation, lived in both New Jersey and Pennsylvania, and when he passed away, both states said, "Oh, you owe us estate taxes," because he lived in both states and he had so much money. The family sued back saying neither state had a claim for the full amount, and they battled it all the way up to the Supreme Court twice, and it raged on for 6 years, and after 6 years of court battles, the John Dorrance estate paid taxes of $15 million to both states. So I read that to be $30 million total. So make sure you set these things up carefully if you're planning on being a millionaire, especially. Make sure that you set things up carefully. Some other legal papers that you should consider having: a power of attorney designates an attorney in fact that gives a person a written authority to act on your behalf should you become incapacitated. They can act on your behalf to sign contracts, buy and sell assets, pay bills, etc. However, you don't want to give somebody so much power over you they can just ruin you. You can also use what's called a limited power of attorney, used to allow attorney in fact to accomplish very specific actions, and you can also do it for a certain amount of time. So like medical power of attorney happens like if somebody's going into surgery where they're going to be under anesthesia, you can give a medical power of attorney for somebody to make decisions on your behalf while you're under surgery, under sedation, so while you can't be asked questions. Also, advance directive designates your healthcare choices and designates who will make the choices for you if you're unable to do so. This is for someone who wishes to have like a do not resuscitate, don't put me on life support kind of situation. This is the person you ask that question to, and they're going to decide what to do, because I can't decide for myself. In a similar fashion, the living will decides what life-sustaining medical treatment you will allow or will not allow should you become incapacitated. And this is usually a lot for like emergency situations, like if you were to be admitted through an accident or go through the ER, your living will would kick in to say this person doesn't want blood transfusions. There's certain religions where you don't want blood transfusions, or don't do any kind of breathing apparatus, don't intubate or something like that. A durable power of attorney for health care authorizes a person to make medical decisions on your behalf, usually under very specific circumstances. So some important papers checklist, things that you need to keep handy. Mine are in a fireproof box at my house because I don't have a safe. Certificates such as the birth certificate of everyone that's part of your household, marriage certificates, divorce papers as applicable, legal name changes, your social security document, and your automobile registrations and titles and stuff like that, deeds to houses. Military service records, any kind of veterans documents that you need to prove your service. Insurance policies, any kinds of joint bank account records so you can see who has access to your bank account, safety deposit box records and keys, stocks and bond certificates, the title to your house, mortgage documents, etc., and retirement accounts so people know what you have when it comes time. There's even a book that I saw, it's available on Amazon, again, not sponsored, that you can get. It's called I'm Dead, Now What? And it literally is like a notebook where you put all of these documents in and write down wishes and stuff like that, and it's kind of handy. So charitable giving, remember we said we'd come back to it. A reflection of your personal values. You don't have to give anybody any money. It's your money. You can use it for tax advantage. Donations to 501c3 organizations are tax deductible if you itemize your deductions. If you don't itemize your deductions, you don't get the advantage of that. And, it just depends on what your deductions look like. Is it more advantageous to take the standard deduction or to itemize? It depends on your expenses. And you can go either way. You can flip back and forth. It doesn't, once you lock in on something, it doesn't mean you have to do it that way all the time. As the printing of the book, or as of 2016, you can give away up to $14,000 per event, individual without you paying any gift tax. We just found out it's now up to $19,000, but this is not a tax deduction for the giver. But it does impact, it's not really a tax deduction, it's just money that you can give away without having to pay taxes on the money that you give away. So, all right, so I think you should, as a follow-up to this, try to research your future Social Security benefits. Start thinking about how much you want to allocate toward retirement savings. If you can, open a traditional and or a Roth IRA or 401k, depending upon which way you want to go. Create a will and advance directions. Discuss your wishes with other people, but just remember that discussing your wishes with other people does not make it something that's going to automatically happen. A will is the way to go, or a medical power of attorney, or a living will, or advance directives. Because no amount, if you get into the situation, no amount of she never wanted to be on life support is going to stop a medical person from putting you on life support unless there's an actual legal document there saying not to do so. And make plans for your charitable giving, and try to start thinking about, at what age do you want to retire? Most people say, yeah, I want out at 62, but if you do, you want to make sure you've got enough money set aside to do so comfortably, remembering that Social Security by itself is not a retirement plan. And so how much money should you set aside for retirement savings? Are you where you need to be right now in your life? What do you plan to do to stay on track? And what are you giving back in terms of your time and resources? So that is chapter 16. Chapter 17 is super short, and I'm going to try to be a little bit better about this than the last time I recorded it, because last time I recorded it, got a little emotional on it, so we're going to steel ourselves up for that. Chapter 17 talks about financial planning for life, and you're going, why did she get emotional over that? You'll see in a minute. The learning objectives are you want to assess your financial plan against your values, vision, and life goals. Evaluate the sustainability of your financial plan because it is the key to your plan's success, and recognize the importance of evaluating the progress of your goals, towards your goals, as well as your goals' proper fit on an annual basis. What worked a year ago may not be working for you now. So balance. Remember, you need to prioritize and assess your financial plan against your values, your vision, your life goals. Focus on things that bring meaning to your life. Work is wonderful, but it should not be all that you have. A lot of people are workaholics. I've been accused of it myself, but trust me, I'm about that work-life balance too. When it's time to go, it's time to go. Go home. I don't have, so many people have their email on their phone. I'm not about that life. That kind of stuff don't bother me unless it's, this is super important. Economize, live within your means, develop a budget. It's so easy to overspend, and now you find yourself in a hole where you can't get out of. And don't procrastinate, energize yourself. Remember what I said, start early with these savings plans and these retirement plans so you don't have to give as much money every time, but you give for a longer period of time. If you know what's important to you, decision is easy. And here's where I got kind of messed up the last time. This is a quote, and it doesn't say who wrote it, but anyway, it says, remember that balance is so important. Life is more than the money you have in the bank, the cars you drive, and the houses you own. When you come to your last days, your investment portfolio won't matter nearly as much as the relationships into which you have invested your time. Make your emergency plans, set aside your savings, put some money into investments, but all the while, be sure you're putting as much time and energy into those precious relationships that surround you. If your investments ever fail or emergencies deplete your savings, having a strong bond with friends and family will get you through. And these are the investments that's really going to matter throughout your life. Like I said before, earlier in chapter 16, the life stages that we were going through. When your kids are little, take time to spend with them, to watch them grow up. Even though it might make the budget tight, take a family vacation and go see things. Some of my most precious memories with my parents were when I was young and we would go some goofy little place. Even if it's not very far, it's just getting away and having some fun time together. So invest in people, not just in money. So the next slide talks about sustainability. And it talks about frugality, the concept of frugality, being frugal. Frugality is not depriving yourself, and it's not being cheap. It's about not being wasteful. And so what you want to do, go back to your values, get a monthly budget, get an annual budget, and review these things regularly to make sure that you're doing things that you're supposed to be doing. If you don't watch a whole lot of TV, then stop paying a high cable bill and put that money elsewhere. If you've got a lot of streaming services and you go, wow, I haven't watched a movie on blah, 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 blah in months. Well, turn it off. You don't have to keep paying it. Just unsubscribe. And then take that money, whatever it is, and add it in to some other activity that you want to do. Let's say you've got a $40 a month subscription to a streaming service. I don't know how much they cost. I'm just picking $40 out of my head. But anyway, say you have a $40 a month subscription service that you're paying to something you don't ever watch anymore. Take that $40 and take your family somewhere, to a park or something, and buy some groceries for a picnic. I don't know. Just do something with that money that's meaningful. Don't just let it waste away. Reassess your investments to make sure that they're paying off for you. Make sure you have enough insurance for your needs, and do this annually, monthly, whatever is necessary, but continually reassess. Every year when it's time to redo my car insurance, I look for better rates in all the companies just to see if I can save some money. Is it a little bit of effort? Yeah, but is it worth it? Sometimes. It just depends. So Finally, then, like I said, 17 is short. Money is only one of many resources that can be used to accomplish your goals. Goals should be based on your values, your vision, and your mission in life. Please remember that money does not bring happiness, but using money as a resource in alignment with your values, vision, and goals can increase your happiness. I don't know if you can hear or not, but there's somebody out in the hallway that is just laughing, and it's just making me smile because we're talking about happiness, and they're out there just laughing so hard. But anyway, there's a joke that I always tell in class that says it's easier to cry in the back seat of a Mercedes than it is on the seat of a bicycle, and that is true. But the money itself does not bring you happiness. It's what you do with your money. It's how you spend your time. It's how you share it with others. And so there's it says on the slide, it says 90/10 or 80/10/10. It's up to you. That's a little giving versus saving versus spending formula. Like the 90/10 says, spend 90, save 10. 80/10/10 is spend 80, save 10, give 10. You can do 70/20/10. You can divide that up however you want. It's up to you. But understand that everything you do has an opportunity cost. If you spend all of your money and you save none of it, later on you're going to not have what you need when it's time to retire. Your personal finance situation is personal. It's all about you. So you need to envision what's going to do the best for you. So, in summary, assess your financial plan against your values, vision, and life goals. Evaluate the sustainability of your financial plan because it is the key to your plan's success. Recognize the importance of evaluating progress towards your goals as well as your goals' deeper fit annually at the very least. Get to work on moving out, planning. You could plan all day. Unless you do something about it, you've just wasted time planning. So planning is important, but it doesn't work unless you actually do something about it. So plan and then do. Get a retirement plan set up. Get a savings plan set up. Get a 401k or an IRA set up. Make a plan for how to have money to live off of when you get older. Don't be afraid to ask for help. There's people you can pay to do it. There's people that will do it for free. So just ask for help along your path to financial success. You can always refer back to the book or to online resources for specific stages of your life. Share what you've learned to help others along the way. Use your life experiences to help others along the way. And if you really want to learn something, know it well enough to teach it to others, which is kind of true. Think it through. Expect your goals to change as you and your circumstances change. Constantly reevaluate, learn, and act on new information that you've gained. This is life, your life. Live your life to the fullest and use your resources to accomplish your goals. There's a little arrow on the slide. And then there's a nice little pretty picture that says financial success, you're on your way. I want to say in conclusion that I hope that you have found something useful in this class. I feel like this class is a very common sense, step-by-step way. I hope that you have found that working through the continual case study and learning about all the people at 906 College Street and how they went through their lives and what you helped them decide on will help you make decisions in your own life. I also want you to know that reach out to me. I'm one of the persons that it says, reach out to people for help. If I can help you, I'll be more than happy to. But I need to know you need some help. I'll be around. But I wish you all the best, and I hope to see you soon in person. Take care. Goodbye.